No, not on me. Good morning, everybody. Here's Tony. We're here to give you the daily bites for today, June 16th, 2023. Great to be with all of you today. Let's talk about markets here. Boy, what a day on Tuesday. It was quite a rally. Let's take a look at the chart here as we can see it in full view. And you can see that following the CPI release, which came out on Tuesday morning, markets shot up, gapped up, left a huge gap in the chart here, much like we did a couple of weeks ago. And we made a higher high and a higher low yesterday. So, but we did finish with a doji here yesterday. So it tells us what? It tells us yesterday's high, call it about 45.20, is going to be some resistance. So 45.21. So it's going to be some resistance up there. Makes sense because the high from early September was about 45.27 or 45.30 roughly. Except right here. Oh no, even higher than that, 45.41. So that's going to be your marker there to exceed September. And of course, we closed at 45.15. Just a little bit lower than we are right now, so we're eating into that that resistance area right as we speak. So we were off quite a bit more earlier this morning, and then some economic data came out on at 8:30, about 15 minutes ago, and the markets have rallied back a bit, but we're still down about 25 handles on the NASDAQ. Dow Industrials down about 50, thanks to Walmart, which shot itself in the foot and gave some conservative guidance for this next quarter. We've had some other good, not so good reports last night. Of course, Cisco, which is another Cisco Systems, which is another Dow Industrial stock, is getting pounded today, and some of these dragging down a lot of other technology names as well, down to about 10%. Palo Alto Networks, which actually came out with really good earnings and guidance too. They a little bit of hair on the report with the weakness in billings, I guess, but still stock had been up quite a bit. You can see that on the chart over here. Stock had been up quite a bit for the past couple of weeks, from about 230 all the way up to about 265, 267 yesterday. Big outside day yesterday. So we're going to open a bit lower. I think if we get down to this 20-day moving average here, let's call it around 246, maybe even lower than that, I think that would be a good spot to start scooping up some shares. Competitors like CrowdStrike, CyberArk, Zscaler might also pull back on this report. So heads up there. Those might be stocks to take a look at. I do have a lot of CrowdStrike and have been rolling into it, rolling into higher strikes as well too. Speaking of rolling, it's a great strategy if you're an options trader and you want to stay with the trade. If you have a nice big winner, why do you want to leave yourself exposed to losses? What you need to do is you can, like I said, you have all the tools of flexibility right in your hands, right? So yesterday, for instance, we had a couple of trades on, which, by the way, very proud of what we've done, what we've accomplished here for the past couple of months. As you can see, yesterday we were up 2.79%. The S&P 500 was flat, roughly flat. Week to date, this is the S&P 500 up 2%. We are up 10.2%. We're up 5 times more than the S&P 500. Year to date, we're up 14.25%. S&P is up 17.54. So we're just slightly behind the S&P 500. We're trouncing the Dow Industrials and the Russell 2000. Of course, down behind the NASDAQ, as most everybody is. They're up 44% for the year. But we're really happy with how we're doing. So yesterday, talking about rolling trades, right? So this is our portfolio here. I'm going to slide right through there. So DraftKings, right? So let's take a look at. I love the chart of DraftKings. Okay, stock has been doing really well, and for the past couple of weeks, we've entered into trades and banked profits and rolled up. So you can see here on the 2nd of November, we bought the January 27 call at $3.60. It was right in front of earnings. And then we turned around and sold it the next day, the very next day, for $7.70. So we made more than a double on the name. And we banked that whole winter. It was up 115%. And we said, okay, still like the trade, still like the name, like the chart, but I'm going to get into a higher strike and lower my costs once more. So what we did is we rolled into the January 33 call, gave us plenty of time. We had more than 2 months to go before this expired. We bought it at 345, and then yesterday sold that at 540. Not a 100% winner, but still up really strong, up more than 65%. Okay, so and then we rolled it one more time into the February 37 call for $4. So you see what I'm doing here, right? I'm taking some risk, and then when things are working in my favor, taking that risk down and remaining with the trade going forward. Does that hopefully that makes sense to you? This is the way you need to operate if you're trading options, right? Now, could I have just sat there with the January 27 call and just stayed with it and watched it go up? Sure. But remember something, options are not stocks. Options have a decay factor. They continually decay. There's theta decay every single day on options. Doesn't matter how far in the money the option is. So, of course, this 27 call probably went to 10. Fine. Okay. I made 410 over here, and I made another 2 and change over on the other side, well, almost $2. So I made $6. Would I've made if this option had gone to 10, I would have made just about the same amount of money. But I left myself exposed with for those profits to at risk. Okay, does that make sense? Okay, so hopefully that's a little lesson for some of you trading options. So let's take a look at the markets right here. So the Nasdaq new highs and low list, right? This is something I've been watching for months, right? And it's been atrocious. But let's take a look at the New York Stock Exchange, which actually looks a lot better than the Nasdaq now. So we've had a couple of readings of we had one reading above 100 and a couple of readings above 100. So if we I haven't looked at the final numbers for yesterday yet, but this could be on a buy signal here. And much like the summertime, when we had a nice rally, this indicator was also on a buy signal. So we'll see what happens today. I'm not expecting the markets to really shoot higher today, especially in front of tomorrow's. There's a big options expiration tomorrow. It's not the triple witching like we normally have in December. It is a double witching tomorrow. We have a series of options, equity options expire tomorrow, and index options expire as well tomorrow. Yesterday we had the December VIX futures became the front month, so the November one expired on the opening print. So we have that to work with, and we do have volatility is starting to come down here as we normally see during the seasonally strong period around Thanksgiving and Christmas. So so you see the VIX. Let's take a look at that one here. Even though it rose up a bit, let's see here, hang on a minute. There we go. Even though it rose up a bit in the middle of October up to the low 20s, it's right back down to the teens, which reflects what? Reflects some complacency. You got to be careful here, right? You got to have some protection on. And even though markets have rallied here this morning, there's still a lot of buying in the pipeline here, a lot of short covering, a lot of buying in the pipeline, and people are selling volatility as it rises up, especially after the news. Now, let's talk about the news this week. We had the CPI report that came out on Tuesday morning before the market opened, and of course, the market blasted higher off of that report. And the PPI number came out yesterday. Also, positive on the inflation front yesterday. Retail sales came in a little bit better than expected, but still in the negative. Now, what was important about the CPI? And I mentioned, I talked with Leanne about this. And see, where's Tony? Here he is. He's right over here. So I talked with Leanne about this, and I told her, I said, boy, this day seems eerily familiar. And it did, because I told her that, boy, a year ago, in November of 2022, when the CPI was released, I was in California that week. CPI was released, and the market shot up almost 5% in one day. Anybody remember that? It was over 130, 140 handles. The S&P 500 bolted higher after just recently hitting a low of about 3,500 on the S&P in October, just 3.5 weeks prior to that CPI number being released. So the markets bolted higher. A lot of people were short stocks. I was not too much involved in the markets, and I was wrong-footed. This time around, not so wrong-footed. We had a great day on Tuesday, a phenomenal day, probably one of the best days in explosive options history in 13 years, up 6% on that day. And in the chat room, we were killing it with a lot of different names as well too. But my point here is this: is that history sometimes always doesn't repeat, but sometimes it rhymes, and that was eerily familiar. And we've noticed, certainly for the last year or so, and I've talked about this on the Daily Bites, I've talked about it in other places as well too, the fact that when news is released, also a lot of anxiety and a lot of stress is released, and we can see that release coming when volatility is being sold. And so what is the opposite of the volatility selling? It's the equity futures rising, right? See volatility coming down, you see equity futures going up, right? So that's just how markets work. When people are selling volatility, they think that it's a lot less riskier to be in the markets, and we can take a risk-on approach. Maybe that's what's happening this morning. Certainly happened on Tuesday, and it happened a year ago, and it's been happening when news releases come out over the past 12 months. So what am I looking at today? Again, I'm looking at that Palo Alto Networks. I'm also looking at a couple of technology names that if they're pulling back today, like a Qualcomm or something like that. But for the most part, everyone, I've taken a lot of risk off the table. Because the markets have gone up a lot. They've gone up 400 handles, S&P 500, since that low of 4103 just a couple of weeks ago, right? 400 points. It's more than 8.5%, 9%. Now, if you think the markets just can keep going up every single day forever, I got news for you, folks. You're going to be wrong, right? Let's just look for a moment at the S&P 500 and chart it out a minute, okay? And again, I think that a lot of people are still licking their wounds from a bad 2022. I get it, but you don't try and get all of your losses back in one day or 1 week or 1 month, right? You have to understand what's happening in the markets, how the market landscape and the environment is changing, and you make adjustments and you adapt to that change, right? You don't just push yourself in and say, oh, well, over the long term, markets do go up. That's correct. That's true. But you can certainly get hurt in the short run if you're not careful and if you're not paying attention to what's happening in front of you, right? If you're driving down the road, right, your destination is still there, but what happens if some rocks come flying up and hit you in the windshield and crack your windshield? What happens if you run low on gas and you don't have a gas station around? You have to stop and make adjustments. So that's the sort of thing. So let's take a look at this S&P chart and chart it for a little bit, for a moment here. And so what I'm going to do is I'm going to do a Fibonacci retracement from the July high all the way down to this most recent low and see where we're at, right? And so we hit that about 44.10, that's 61% retracement and gapped up. Tells me that eventually we can make a run back towards this July high. It's not too far away. It's only about 100 points away from the S&P 500, 45.02, right? But this level is going to be extremely important because we have a gap just underneath this retracement level, and we've gapped up from this retracement level over here. So we have a nice W pattern here. We could certainly pull back down and create a lower shoulder here. This is a possibility, right? And bounce right back up again in 2024, right? That would be your inverse head and shoulders, right? Left head, left shoulder, head, and then maybe a right shoulder over here. But that would be that would require quite a bit of down move here, right? So what do we have here looking on the chart? I'm going to pull that off. We have a lot of gaps, right? A lot of gaps here in the chart. Okay, just look from here all the way down to here, and that would make sense with the whole inverse head and shoulders pattern, right? If we fill those gaps down over here, if we come back down, that could certainly happen in January, February, because look what happened here back in the spring, right? We had a lot of gaps over here in the chart, and I'm sure a lot of people were saying, "Oh, off to the races, we're not going to come back down again." Well, sure enough, look what happened, right? We came down sharply here and sharply over here as well too, and ended up filling these few gaps that we had in the chart, and even all the way down to here. We even filled that gap. So in fact, we even filled that gap. Well, actually, this one goes down a little bit further than that. Yeah, fill that one down at 41.20. So there we go. So we have some potential downside targets over here. We have a potential upside. So what's your downside, up versus upside risk, right? 100 points, get up here. 300 points to the downside. 100 to the upside, maybe 300 to the downside. Is that a good ratio for you? I don't think so, right? If you're playing the markets right now, I think your odds are against you, right? You can certainly play for that last 100 points, but then after that, then what do you got, right? You've just got a whole bunch of people who piled into the names that you're in, or the S&P 500 or the NASDAQ, and they're looking to do what? They're looking to sell, all right? So be aware of that. If there's some downside here, and the great thing is that the VIX is all the way down at 14%. And what does that mean? It means put protection is cheap. It's very cheap right now. So why not? Why not add some puts out to January or February? In fact, taking a look at the VIX term structure out to January or February. This is VIX Central over here. I mean, the VIX is at just under 14 right now, whereas the January, February is about 17%. Right? So we're looking for less than a 1% move, or just about a 1%, a little over a 1% move actually, for the next couple months, for January, February, right? So why not buy some cheap put protection? And if you're wrong, we can just make some adjustments. You can sell some upside puts against those to create credit spread. You can buy some downside puts to create a vertical put spread long and just reduce your risk. You could also just sell your puts if you're wrong. Okay, there's nothing wrong with being there's certainly nothing wrong with being wrong. Okay, I'm wrong all the time, but I'm fully aware when I'm wrong, when I'm in a bad spot with the markets, and I can make adjustments on the fly. I did this last week. I had some puts. I was pretty heavy with the puts last week, and it was clearly wrong. So what did I do? I ended up selling some upside puts against my long puts, all right, a credit spread. And instead of taking large losses, I ended up basically breaking even, or even in most cases, making a little bit of profit on that, right? Now, certainly not as big a profits as if I was just fully bullish with the markets, like I'm just buying calls and selling puts prior to the markets moving up. Okay, that didn't happen, but I was able to make some adjustments within my accounts, and I ended up again either breaking even or making money. And then I was able to transition into some long calls and even some more short puts into Tuesday, and I closed out all those short put spreads for some really big gains on Tuesday. So That's how that works. So anyway, listen, everyone, I'm gonna cut it right here. It's 9 o'clock. We're about a half an hour in front of the market open over here. I hope you enjoyed learning about a little bit about managing risk today. It's certainly paramount on my mind every single day. I preach it to everyone. The first thing we have to do is manage risk. We always have to wear that risk manager hat during the trading day at all times. Okay, it doesn't matter what the chart looks like. It doesn't matter what the earnings report looks like. We have to manage our risk. We have to be risk managers all the time. Otherwise, I mean, we're just letting our capital float out there, and we're going to be punished like it's nobody's business, because that's what the markets do. They like to punish everybody if you're not managing your risk carefully. Okay, have a great day, everyone, and I'll see you guys all back on Monday. Enjoy the weekend. Trade well today. And I look forward to seeing all of you in the chat room a little bit later on today. If you're not in the chat room, that's the place to be. You got to come in and check it out and see what we're doing over there every single day. Have a great day, everyone, and I'll see you guys all on Monday morning. Take care. Bye.